Ladies and gentlemen, traders and students of the market, I welcome you once again to our exploration of the forces that govern price movements. Today, we are going to examine a very specific and crucial phase in market behavior, what I call the buying climax. Now, if you caught our previous video on trading psychology, you will understand that the mind of a trader is as important as the chart itself. The behavior of the market is, after all, a reflection of collective human emotion, and nothing demonstrates that more clearly than the buying climax. Let me ask you this: have you ever noticed how prices can surge with almost reckless abandon, seemingly climbing higher every day, while your own gut tells you something isn't quite right? That, my friends, is exactly where the buying climax begins to take shape. A buying climax is the point where public enthusiasm has reached a fever pitch, where demand has been exhausted because nearly everyone who is willing to buy has already done so. And it is at this point that the smart money, the professional operators, begin their work quietly, absorbing supply without causing a panic. You see, the buying climax is not a simple one-day affair. It's a series of stages, often unfolding over days or even weeks. The inexperienced trader might mistake this for a continuation of a bull trend, but the seasoned observer recognizes the subtle signs. The slight divergence between volume and price, the erratic behavior in the final rallies, and the sudden inability of price to make consistent new highs. Ask yourself, are you watching volume as closely as price? Are you aware that volume often tells the real story while price can deceive you? A classic buying climax will often begin with a strong upward thrust on increasing volume, capturing the attention and excitement of the public. Then comes a pause, a hesitation that can be mistaken for consolidation. But careful observation reveals something more. The high is met with relatively lower buying pressure, and the subsequent rallies fail to reach the heights of the initial surge. This, dear listener, is your first clue that the market is shifting from public enthusiasm to professional distribution. Now, it is important to recognize the emotional currents that drive these patterns. Greed, fear, hope, and doubt are all at play, and they are visible if you know how to read them. Have you ever felt that urge to chase a stock, to buy just before it makes another run? That impulse is exactly what the operators rely upon. The buying climax is as much a psychological event as it is a technical one. Remember our discussion on trading psychology. Understanding your own emotional reactions gives you the edge in recognizing the edge of the market. Let's turn our attention to the charts themselves. During a buying climax, look for wide, range bars on increasing volume. These are the telltale signs that the public is buying heavily. But then watch the subsequent price action. Notice how the market begins to struggle to sustain these highs. There may be sharp, quick reversals, known as upthrusts, which trap the unwary. Ask yourself, are you prepared to see beyond the surface of these price spikes? Can you distinguish a genuine breakout from a manipulative upthrust? One of the most valuable tools in your arsenal as a trader is patience. You do not need to be first, but you must be right. During a buying climax, the operator's goal is to sell to the public at the peak of their enthusiasm, and they will often do so in a series of careful, deliberate steps. High-volume days followed by minor pullbacks, then another thrust, then a sudden, sharp decline. This is the blueprint. Do you see how this pattern repeats itself across markets, across decades? History has provided us with these lessons if we are willing to observe closely. As we examine this further, remember that trading is not merely speculation. It is the science of human behavior expressed in price and volume. A buying climax signals the transfer of ownership from the public to the professionals. It is not a time for emotional trading or hope-driven decisions. It is a time for observation, for study, and for preparation. And yes, this principle ties back beautifully to what we discussed in our previous video on trading psychology. Your ability to remain calm, objective, and disciplined allows you to see what the majority cannot. It is also critical to observe the market's reaction after the buying climax. Look for signs of distribution, sideways movements, high volume bars that fail to produce new highs, and occasional sharp drops on relatively lower volume. These are the subtle, almost invisible footprints left by the operators. Can you see them, or are you focusing only on the price itself? The difference between a reactive trader and a prepared trader is the ability to read these footprints weeks in advance, to position yourself before the crowd realizes what has occurred. Now, some of you may be asking, Richard, how can I use this knowledge without becoming a fearful, indecisive trader? That is an excellent question. Understanding the buying climax does not mean avoiding risk entirely. It means managing risk intelligently. It means observing the market, identifying the climax, and positioning yourself for the probable move that follows, rather than chasing the emotional highs. Wealth in trading is built through disciplined preparation, careful observation, and decisive action when the time is right. You must also consider the broader context, the larger trend, the support and resistance levels, and the relative strength of different sectors. A buying climax in one market may be mirrored by weakness in another. The professional operator watches the bigger picture, and so must you. Trading is not a sprint, it is a patient, methodical endeavor. Ask yourself, are you watching only the immediate chart, or are you aware of the forces shaping the entire market landscape? And let us not forget money management, the cornerstone of any trader's longevity. The buying climax teaches us a vital lesson: capital preservation is as important as capital growth. Even if your analysis is correct, over-leveraging or ignoring risk management can erase any gains. By studying the buying climax, by understanding the transfer of supply from public to professional hands, you learn to protect yourself as much as to profit. The final point I will leave with today is the importance of observation over prediction. Too often, traders try to forecast the market based on hope or rumor. The buying climax is a demonstration that the market itself provides all the clues you need, if you are willing to read them. Focus on price and volume, understand the psychology behind the moves, and always maintain discipline. After all, the market rewards those who are patient and observant far more than those who are impulsive. And isn't that exactly what we emphasized in our prior discussion on trading psychology? Awareness, patience, and objectivity are your greatest allies. Now, as we continue to dissect this concept, think carefully about the way a buying climax manifests in your own trading. A buying climax occurs when public enthusiasm reaches a peak and demand is exhausted. Now, let us take a moment to think about what that really means. Picture the market as a living organism, breathing with the emotions of every participant. When prices have been rising steadily, the public begins to notice. And what happens? Greed sets in. Excitement mounts. Every news headline, every chart, every story about the next big thing fuels the desire to buy. Have you felt that rush before, where it seems like everyone around you is making money and you're being left behind? That is exactly the environment in which a buying climax forms. The key to understanding a buying climax is to recognize that it is not merely a spike in price. It is the natural consequence of the market reaching an extreme of human emotion. It is the point at which nearly everyone who wants to buy has already done so, and those remaining who are undecided hesitate because the price feels too high. But the public doesn't stop buying immediately. They continue, driven by momentum, by the fear of missing out, by the hope that prices will climb just a little higher. And it is in this continuation that the professionals, the operators who have been quietly accumulating, begin to shift into distribution mode. They do not act rashly. They absorb and distribute supply in a way that appears almost invisible to the untrained eye. Observe closely, and you will notice certain hallmarks of this process. First, there is often a powerful upward thrust on increasing volume. Prices surge higher than ever before, and the media is quick to celebrate the new highs. Headlines declare a new bull era, and the public rushes in, eager to participate. Have you ever paused to ask yourself whether the surge is sustainable, or if it is simply the final push of those who are late to the party? That surge, that very enthusiasm, is the peak of human emotion manifesting in price. Next, we notice that the rallies begin to change character. The early stages of the buying climax feature broad, confident moves upward, often accompanied by wide range bars and high volume. But as the climax matures, rallies begin to narrow, hesitations appear, and volume patterns shift. The price may still reach new highs, but the ease with which it does so diminishes. These are subtle, almost imperceptible signs, yet they are the fingerprints of professional activity. The smart money is carefully distributing shares to those who are emotionally compelled to buy, and in doing so, they are preparing the groundwork for the eventual reversal. It is crucial to understand the psychology behind this. The public is motivated by emotion, greed, hope, and the fear of missing out, while professionals are motivated by logic and control. Professionals seek to buy low and sell high, or in the case of a buying climax, to sell high to those whose emotions have already taken over. When you witness the buying climax, the lesson is clear. The market is not your friend if you are participating solely in response to emotion. Can you distinguish between the excitement of the crowd and the intent of the operator? That is the question every trader must answer. Volume is a critical component in identifying a buying climax. When enthusiasm peaks, volume often reaches extremes as well. Large, aggressive buying occurs as the public competes for shares, driving prices up at a pace that the market cannot sustain indefinitely. Yet, at the same time, the professionals are quietly taking the other side of these trades. They do not need to push prices lower immediately. The climax itself allows them to accumulate profits as the market prepares to change direction. Another key aspect is the timing and duration of a buying climax. It does not appear as a single moment, but as a series of phases. There may be days, or even weeks, in which the market exhibits characteristics of exhaustion, erratic price behavior, repeated tests of resistance, minor pullbacks, and sudden bursts that fail to sustain momentum. This is the subtle language of supply and demand, written in price and volume. Those who can read it early are in a position to anticipate the shift before it becomes obvious to the majority. It is also worth considering that a buying climax is not inherently negative. It is a natural part of the market cycle. Without it, trends would have no limits, and opportunity for disciplined traders would be limited. The buying climax represents the transition from an upward trend fueled by public demand to a phase of distribution that precedes a reaction or decline. Understanding this allows a trader to position themselves strategically rather than being swept along by emotion or momentum. Now, one must remember that recognizing a buying climax requires more than just looking at price. Price alone can be deceptive, often continuing higher even as demand weakens. It is the relationship between price and volume, the subtle signs of hesitation, and the behavior of the market participants that provide the real evidence. A wise trader observes, questions, and analyzes. Do you see how volume, behavior, and psychology come together to create this critical market event? It is this observation, this attention to the market's narrative, that separates the prepared trader from the reactive one. A final point to consider, though not an ending thought, is the role of human nature. Public enthusiasm is boundless when unchecked, and the market reflects that boundlessness until it reaches the natural limit. The buying climax is simply the manifestation of that limit, the point at which human desire has been fully expressed and supply can no longer keep pace. To a trained eye, it is an opportunity to learn, to anticipate, and to prepare for the next phase of market movement, without the interference of emotion clouding judgment. Professionals absorb supply quietly during the climax, setting up distribution. Now, let's consider what that truly entails. While the public is caught up in excitement, watching prices soar and thinking they are part of a continuing trend, the professional operators are quietly executing a plan. They are the unseen hand guiding the market, absorbing the shares that the emotional public is eager to sell at elevated prices. Have you ever wondered why, despite all the buying frenzy, prices sometimes refuse to move higher with conviction? That hesitation is no accident. It is the fingerprint of smart money activity, and understanding it is critical to mastering the market. The idea of absorption is simple in principle, but profound in its execution. When prices reach a climax, there are plenty of participants willing to buy, but there are also those who are ready to sell, driven by fear of loss or the desire to take profits. The professional operators step in and take the other side, buying from those sellers without letting prices collapse. Their goal is to quietly accumulate, or in the case of a buying climax, to position themselves for distribution, without alerting the public that the market is shifting. Ask yourself, can you see beyond the obvious price movement and detect where the real supply is being absorbed? This is the difference between reactive trading and strategic trading. Observe closely, and you'll notice a pattern. During a climax, the market may make strong upward moves, yet the volume begins to tell a different story. The volume may spike during aggressive rallies, but follow-through becomes weaker. Wide range bars that once signaled conviction now. The professionals are absorbing the shares handed to them by those who are emotionally compelled to buy, all while keeping the market from turning sharply against the crowd too soon. It is subtle, almost invisible to the untrained eye, but those who study price and volume together recognize the signals. One of the most fascinating aspects of absorption is the patience it demands. Professionals do not need immediate action. Their goal is not to generate short-term excitement, but to quietly position themselves over time. They allow the market to move in ways that encourage participation by the public, feeding the illusion of continued demand while systematically managing their inventory. This is a crucial lesson for traders. The market often moves contrary to public perception, and those who can detach from emotion and observe patiently gain a distinct advantage. Absorption is also reflected in the behavior of rallies and pullbacks. During a buying climax, you might see sudden surges that seem unstoppable, only to be met with minor declines that do not last. These pullbacks are often caused by the operators distributing shares slowly to eager buyers. In effect, they are controlling the pace of the market, ensuring that supply is transferred without creating panic. Have you ever wondered why markets sometimes seem to defy logic, moving in fits and starts rather than in a smooth trend? That is exactly the market's way of balancing supply and demand under professional control. Another key point is that absorption often occurs over several trading sessions, sometimes weeks. It is not a single bar or a single day that defines the climax. It is the series of carefully orchestrated moves that gradually shift ownership from the public to the professional operators. Watch for periods where price seems to drift sideways or struggles to make new highs despite strong rallies. These are signs that the market is digesting the recent surge in enthusiasm, and that the operators are quietly absorbing supply. The ability to recognize this pattern ahead of time is what allows a trader to anticipate potential shifts in the trend before the majority notices. Psychology plays a major role in this process. The public is often motivated by emotion, greed, fear of missing out, the desire for quick gains. Professionals, however, are motivated by strategy and discipline. They understand the cyclical nature of the market and the inevitability of profit-taking. Absorption during a buying climax is a perfect example of the contrast between emotion-driven trading and logic-driven trading. Are you trading because of your impulses, or are you observing the market and allowing strategy to guide your decisions? That is the question every trader must confront. It is also important to recognize that absorption is not manipulative in a malicious sense. It is simply part of the natural market process. The operators provide liquidity to the market at the very moment it is most demanded, taking advantage of the public's emotional intensity while maintaining balance. The market cannot move upward indefinitely without this invisible support, and the professional's ability to manage supply quietly ensures that the transition from enthusiasm to distribution occurs smoothly. In addition, absorption teaches an important lesson about risk management. By understanding where supply is being quietly absorbed, a trader can avoid the pitfalls of jumping into a market at its emotional peak. Patience, careful observation of price and volume, and recognition of professional activity are all tools that help preserve capital while positioning for the next significant move. Do you see how this concept ties directly into your ability to remain disciplined, objective, and patient in your trading? Another critical detail is that absorption sets the stage for what follows a shift in control from the public to professionals. When the buying climax reaches its final stages, the market is primed for distribution, and those who have carefully observed the absorption process are in a position to anticipate this change. By paying attention to subtle shifts in price behavior, volume patterns, and market psychology, traders can recognize the moment when the public's enthusiasm is fully exhausted and professional distribution is complete. Finally, it is worth noting that the skill of identifying absorption during a buying climax is not instantaneous. It develops over time through careful study and practice. Each market offers its own lessons, and each climax provides clues about the balance of supply and demand. By focusing on these lessons, and by learning to observe without being swayed by emotion, a trader builds the foundation for long-term success in navigating the markets. Emotional impulses like greed and hope amplify public buying. Now, consider this carefully. The market is, at its core, a reflection of human behavior. Prices move not simply because of economic fundamentals or news events, but because of the collective emotions of those participating. Greed, hope, and fear are powerful forces, and nowhere are they more visible than during a buying climax. Have you ever felt that irresistible pull to join a rally, convinced that this time is different, or that the trend will never end? That is the very emotion that drives the public to overcommit, to buy at prices that are already elevated, and to create the environment in which a climax can form. Greed, in particular, is a driving force. When traders see others profiting, the desire to participate intensifies. People often ignore warning signs because they are caught up in the excitement of potential gains. The professional operators, the smart money, understand this dynamic and exploit it. They know that public enthusiasm reaches a peak when greed dominates decision-making, and they use that moment to transfer shares from emotionally driven hands to those who act with patience and discipline. Ask yourself, how often have you felt the tug of greed, convincing yourself to buy just a little more, even when logic and analysis suggested caution? That tug is not a weakness, it is a predictable human response, and recognizing it is part of mastering the market. Hope is another emotion that fuels buying. Hope is subtle and persistent. Even when the market shows signs of fatigue or hesitation, hope keeps the public buying. Surely it will go higher, they say. Just a little more, and I'll be safe. Hope can mask the reality of exhaustion and create false signals of strength. This is why understanding human psychology is as important as reading charts. Prices alone cannot tell the full story. One must interpret the motives behind the actions. Are people buying because the trend is strong, or are they buying because hope has clouded their judgment? Recognizing the difference separates those who merely react to price from those who truly understand market behavior. The combination of greed and hope produces what I call emotional overextension. Traders pile into positions without regard for risk, believing that momentum will carry them further. Volume swells, prices surge, and the buying frenzy becomes self-reinforcing. Yet behind this frenzy, the professionals are quietly observing, absorbing supply, and preparing for distribution. They are aware that these emotional impulses are temporary, and that markets cannot sustain irrational enthusiasm indefinitely. Can you see how the same emotions that drive public buying also set the stage for the professional to act? Another critical point is that emotional impulses are predictable. While the timing of the market cannot be forecast with absolute precision, the human reactions that shape price behavior are remarkably consistent. Every market cycle demonstrates the same phases: enthusiasm builds, greed intensifies, hope prolongs the trend, and eventually exhaustion sets in. By studying these cycles, traders can anticipate the moments when emotional buying is reaching its peak and when the transfer of shares from public to professional hands is underway. Observation, patience, and discipline are the tools that allow one to act on these predictable emotional patterns. It is important to note that emotional impulses are amplified by social factors. When traders see others profiting, when media headlines celebrate new highs, and when peers boast about their gains, greed and hope are reinforced. This social validation creates a feedback loop, intensifying the buying frenzy and further inflating prices. The professional operator understands this loop and uses it to their advantage, gradually distributing shares into the hands of the public. While by preserving capital during a climax, you ensure that you can participate in the future without being sidelined by losses. Psychology ties directly into money management. Greed can tempt a trader to ignore stops or overcommit, while fear can lead to premature exits. Recognizing these impulses and integrating them into a structured plan is key. When a buying climax is underway, one must constantly ask, am I following my plan, or am I reacting to emotion? The answer determines whether money management is real or merely theoretical. Another critical aspect is patience. Risk control is not about avoiding the market entirely, it is about engaging intelligently. By observing signs of exhaustion, volume divergences, and distribution patterns, a trader can make informed entries and exits while limiting exposure. Money management allows you to participate without being consumed by the volatility inherent in climax phases. Finally, risk management during a buying climax is a lesson in humility. Markets are larger than any single trader, and no one can predict every move. By respecting this fact, adhering to position sizing, stops, diversification, and capital preservation, a trader ensures longevity. Discipline in money management is the foundation upon which all successful trading is built, especially when the public is at the peak of enthusiasm, and the professionals are quietly managing the transfer of supply. Volume patterns reveal the footprints of professional activity. Now, let us consider this carefully. Price tells part of the story, but volume is the heartbeat of the market. Without studying it, you are reading the market like a book with half the pages missing. Volume is the evidence of participation. It shows who is active, who is hesitant, and where the real supply and demand lie. Have you ever noticed how a price surge with weak volume often fails to hold, while a subtle advance on strong volume can sustain for weeks? That contrast is where the professional trader finds their edge, because the public tends to focus only on price, not the deeper story that volume tells. During a buying climax, volume behaves differently than the casual observer expects. It is not just the magnitude of volume that matters, but also the sequence and context of the bars. At first, volume may expand as public enthusiasm grows, confirming the rally. But soon something changes. You start to see spikes in volume that accompany small or failed advances in price. These are clues that the market is encountering resistance from professional hands absorbing supply. Ask yourself, are these volume patterns showing unbridled buying, or are they revealing hesitation and controlled distribution? Learning to read this subtle distinction separates the reactive trader from the strategic trader. Volume analysis requires a careful eye. Watch for instances where a rally to new highs is accompanied by declining volume. This is a warning signal. The public may be buying enthusiastically, but the lack of follow-through volume suggests that the smart money is not participating with the same intensity. Conversely, sudden surges in volume on small pullbacks or sideways bars often indicate absorption by professional operators. They are quietly managing positions, transferring shares from emotional hands to disciplined control. Volume, in essence, is the signature of the market's invisible forces. Another aspect to consider is climax volume itself. The highest volume often occurs not at the very peak of price, but during the reaction immediately following it. This is because professional operators, having absorbed supply, begin to redistribute it carefully. The public, caught up in emotion, frequently sells into this distribution, believing they are taking profits from a continued rally, unaware that their enthusiasm is facilitating the transfer. Can you see how reading volume in context gives you insight into what the market is actually doing, rather than what it appears to be doing on the surface? It is also essential to study the relationship between price and volume over multiple time frames. Intraday spikes, daily patterns, and weekly accumulation all tell a cohesive story when examined together. Volume should never be interpreted in isolation. A high volume day on a long-term uptrend may signal a different dynamic than a similar spike on an exhausted rally. The professional operator knows how to connect these patterns, observing the larger narrative while making tactical decisions in the smaller frame. Volume divergences are another powerful tool. When price makes a new high but volume does not confirm, it is often a signal of waning demand. Professionals recognize these divergences and use them to guide distribution strategy. The public, however, sees only the new high and assumes the trend will continue. By comparing volume with price behavior, a trader gains insight into the balance of supply and demand and into the timing of potential turning points. Volume also communicates conviction. Large advances on expanding volume suggest strong participation, whereas advances on shrinking volume indicate that enthusiasm is limited and potentially fleeting. Pullbacks on strong volume reveal absorption or selling by the professional, while small pullbacks on low volume often show indifference or a lack of commitment from the public. Each of these signals provides clues about the underlying dynamics of the market, if you are willing to observe carefully and objectively. In addition, patterns such as climactic volume followed by decreasing spreads and sideways bars often indicate the final phase of the buying climax. The public continues to buy emotionally, but professional hands are quietly managing supply, preparing for distribution. By recognizing this, a trader can anticipate shifts before they become obvious to the broader market. Have you noticed how often these subtle volume patterns precede reversals that seem sudden to the majority of participants? That is the invisible hand at work. Volume teaches a broader lesson about patience and observation. While price may capture attention, volume reveals the decisions behind the price action. Every surge, every hesitation, every spike tells a story of who is in control, who is passive, and who is preparing for the next phase. The trader who studies volume develops the ability to detect professional footprints and align with them, rather than being swept along by emotion-driven movements. Finally, mastering volume analysis is not just about technical skill, it is about cultivating a disciplined mindset. It requires you to watch, wait, and interpret with precision, resisting the urge to react impulsively to price movements. By understanding the messages volume communicates, by learning to read the signals of absorption, distribution, and professional activity, a trader gains insight that transcends ordinary chart watching.